Hey everybody, we're back with another session. It's going to be a quick one today because we're talking about the estate bond. It's going to be quick because this is the simplest and purest form of the idea. The idea that the cost of tax is greater than the cost of insurance. And so why is it called an estate bond? Well, generally because it's using estate capital. What do we mean by estate capital? We mean the money that somebody is probably never going to be able to spend. They have their planner, they've got a lot of wealth, and their plan says they're going to grow this money and then they're going to spend some money and then they're going to have taxes. But there's a whole chunk of change that they really couldn't spend even if they tried to over the course of their lifetime. And so, what can they do with that to avoid that huge chunk going to the government? Well, we're going to position insurance as an alternative to that. And so, what happens if they don't do anything? Well, as it grows every year, they're going to have to pay some tax on it. And then when they want to use it, they're going to have to pay some tax on it. Or if they don't use it and it goes to their estate, they're going to have to pay a whole bunch of tax on it. So really, the bar is not set very high for how we can show insurance as a better alternative to this. With the oppressive tax regime that exists in Canada, it's not hard. And not to mention the other ancillary benefits that we have in terms of bypassing probate or CDA credit if we're in a corporate circumstance. Really, this one's a bit of a no-brainer. And so here is a nice little pictogram that goes through how this actually works, right? In your basic scenario, they go through and they buy their investments and they're taxable and then they pay tax and then there's tax to be owed on the income and capital gains and on death, everything else. Or their second option, they could buy an insurance policy. It could grow tax-free. It could be paid out through the capital dividend account and go to their surviving shareholders tax-free. When we eliminate one or two layers of tax, we start to see a much higher level of benefit. And what does that benefit actually look like? Well, here's a good example. That same 50-year-old male non-smoker that we use for a lot of our examples, there isn't a point over the course of this where it isn't better. And the real numbers are quite significant. Almost twice as much is going to be left after tax and everything else to their next generation than would be in an alternative investment. And this isn't in 3% GICs. This is if they were in a relatively more balanced to aggressive portfolio. Now, remember, we're talking about estate capital. And when most people have that estate capital, they've got it in lower yielding, higher taxed environments, which means it's going to look even better in comparison to that. So this is just a quick hit to just say, you don't have to be afraid of going out to some of the wealthiest people that you know. If they've got more money than they can spend, they are likely going to end up giving more than their fair share to the government, both while they live and when they pass away. And there's a simple way to come in and have this conversation that gives them an alternative, that gives them control and efficiency, and get to feel like they're keeping more of that hard-earned wealth.